Despite a recent rally in global equity indices, increasing numbers of people are concerned about the outlook for the markets. Indeed, at the time of recording, there has recently been a bit of a wobble. What do you do if there is a sell-off? On the way down, the temptation may be to sell into the recent rise to lock in profits. But what then? The chances are that any attempts to time the bottom won't reap any long-term rewards. How should we as investors get our minds around the issue of volatility? Welcome to today's IG Trading the Markets podcast. I'm Jeremy Naylor. We're pleased to be joined today by Luke Hickmore, a veteran of the financial markets and as investment director at Aberdeen has to deal with this very subject of volatility almost on a daily basis. Luke, welcome. I hope you don't mind me introducing you as a veteran, but I know you've been around the markets a long while, certainly enough to be able to give us some sort of context on this subject today.
Morning, Jeremy. Yeah, 35 years. I think I'd be hard pressed not to describe that as a veteran. And you're right. The daily volatility and talk around the team at the moment is massively elevated.
Yeah. So before we get into the psychology, our subject of this podcast, I'd like to get your feel then for what is happening in the markets at the moment. What is that discussion you're having around the table with your colleagues? Are you preparing for a relatively hefty drop in these benchmark indices?
Yes. So bearing in mind I'm a credit investor, but the thing about credit is you get pushed around by almost every other asset class as well. And at times you lead those other asset classes as well. So for sure, we're feeling the volatility in equity markets, we're feeling the volatility in bond markets. That's all coming through into our book as well. And recently we've started to add in more and more protection against downside risk. So using the CDS indices, which are like buying insurance against underperforming credit markets over the next few months, and we're planning to do that every Wednesday. And I think that's one of the approaches that you can have is more of a structured, thoughtful approach that's not always just about responding to the latest spike or trough. But I think we will get into a tough, probably end of Q3, Q4, and it may take the Q3 reporting season to really get investors to understand how much of a cost squeeze companies are going through. At the moment, their revenues are okay. One of the things, of course, Jeremy, with inflation is it keeps nominal revenues quite high. That, of course, is under threat as inflation comes down next year. And those cost pressures are still going to come through. And I think we're going to see investors really start factoring that in to their 2023 and 2024 earnings projections as we go through Q4 this year. That could be a pretty bumpy ride. And I am certainly expecting risk markets to be lower as we go into year end.
That's a really interesting comment about inflation because, like you, I've been in the markets a long while, and people use equity markets as a hedge against inflation, don't they? They ride the wave, if you like, and benefit because otherwise, I mean, if you've got money to just sitting around in a cash account, 10.1% inflation we got here in the UK. Your money has been absolutely trashed by this rise in inflation we got at the moment. Do you subscribe to this idea that maintaining exposure to the equity markets is good because it does give you that hedge?
Yeah, I think that is the case. You have to be cognizant that there's a change in leadership in those markets, that equities have got, much like bonds, a duration risk, i.e. their prices will fall as interest rates rise, but you can be into the sectors with lower risk of that happening. So, and that tends to be the kind of industrial sector of the economy. If you look back in time, they've got great track record on controlling their margins, which is exactly where you need to be right now. But in the consumer end of the equation, that's a very, very different kettle of fish. I mean, this morning's retail sales number is enough to scare anybody off that sector, I would imagine, given that there were lots and lots of signs that the lower income cohorts, as we know, are struggling, and that's really coming through in the numbers. But people are stopping buying furniture, they're stopping buying white goods, they're starting to hoard. So avoiding those areas that are, one, about long time until you get the profits, kind of software industry, IT industry, focusing on those areas where people are still going to need stuff. And this is typically industrials, the chemicals groups, the junior mining sector, for example, in electric vehicle cars, I think is one worth looking at. Those sort of areas I think could still work. And with broad equity markets, you can always find a way through that. And it's probably one of those good times, I think, Jeremy, that you can be active when you're coming into these drawdowns and recessions and difficult growth periods. I feel that's a great time to be active with your investments and think about that rotation, think about who does well and who does badly, rather than just buying the smorgasbord of an index.
Yes, of course, this is what's benefited from the likes, of investing profiles of people like Warren Buffett have done so well at this. And of course, they feed off people's worry in the markets, don't they, and look for areas that have been beaten up. Let me just quickly pick up on one word you mentioned in that answer, and that is risk. One other thing we need to discuss is that investor profiles vary across the risk spectrum. What should we be mindful of? I mean, different ages, different groups of people, different people have different risk appetites. So I guess different people will be doing different things at different times in the market.
Yeah, absolutely. And I think that's a really important point. Actually, if you've got quite a high risk appetite, typically if you're young, you've got 30, 40 years to get over the mistakes that you are going to make as an investor, be patient, hang on to what you've got. Make sure you're in businesses that are survivable for sure, but you want to be diverse, both value and growth. But you can have that growth, you can hang on to that growth. And I'm not sure who said it. It may just be me. I very much say I'm very bad at coming up with market sayings, but I think patience does lead to profits if you've got a high risk approach. If you're lower risk approach, you should be thinking about how you rejig your portfolio, even with drawdown in equity markets being so much. Drawdown in bond markets has been there too, and actually now that's leading to a lot of situations where you're getting really good yields. So your risk appetite does make a difference, but perhaps not over the medium to longer term. If high risk, hang on, be patient. Lower risk, use this as another time to revisit how your portfolio is balanced. If you found it's gone down more than you would have expected, perhaps actually your portfolio is not fully reflecting your risk appetite.
Let's move on now to this point about psychology, because investing for the long term and trading for the short term, what mental setup do we need to have to take advantage of a particular market?
I think job one for me is knowing yourself, knowing who you are as an investor. I know I tend to be bullish. I make sure I work with people who are more balanced or even a little bit bearish to make sure that, I can rein that in, particularly at times when volatility is rising. So that's the first thing. Don't do it on your own. Know who you are, find other people that don't entirely agree with everything that you say, because I think at that point, you're not trying to avoid doing a trade, but just make sure you've got the right reasons to do it, rather than everything's fallen, therefore it must be cheap, therefore I must be buying lots and lots of it, because that could be completely the wrong strategy. So that's job number one. Get a team, get people you're happy to work with and share those ideas and move forward with them. Secondly, I think dollar cost averaging into positions, if you can, is the best way of avoiding all of the problems of volatility. Now, that's not always the case, of course. Not all of us are feeding into a pot of money that's growing. Many of us are, and certainly as a fund manager, have got an existing pot of capital that you're trying to deploy or protect. But you can use derivative strategies to do that, which is certainly what we do for some of our funds. As I was mentioning earlier, is we'll layer in the risk on a structured basis. Layer off the risk, Jeremy, on a structured basis. Even if it's just every Wednesday, it's avoiding that getting sucked in to those spikes and troughs, and thinking, as you mentioned at the beginning, the market's gone down, everything's dreadful, I can see no way out of this, sell. Because you are often just giving money to other people at that point. be more structured about it, be very thoughtful about it, and know who you are, I think, are probably the three key rules.
I mentioned age as one of the things, and as I said at the top, you've been around in the markets a long while. You mentioned bullishness as a typical sort of trait of your personality. Do you find, if you can look at this objectively, do you find that bullishness is fading as you move closer to retirement?
No, I don't think so. I think it probably gets worse. you almost think you know more than you really do, because you've been around a long time, and that's a danger as well, is that you're missing maybe some shift underlying that's going on that the economists have spotted. That as I said, you've got to be very careful about the investments you're buying and who they are exposing you as well. So no, I haven't found that's tempered as I've got older at all. If anything, I have to work harder to avoid being too bullish.
Hmm. Do you think, as a society, us humans, I should say, are any of us hardwired, do you think, to trade or invest? Is this something, do you think, can only be acquired through teaching and education?
I've certainly come across some natural traders, for sure, who, even when they're an intern or an early graduate scheme, very balanced. They're very calm. They are able to be incredibly logical with their approach. They know themselves ever so well. And often they end up being very, very good fund managers, or even just traders at some of the investment banks. And I have seen that. And it's not, I would say, massively uncommon, but it's certainly not the majority. The majority of us, I think, need to get over that gap between knowledge and intelligence, and that gap is experience, isn't it? It's being taught, it's learning, it's suffering, it's going through your mistakes and learning from them. But whilst you're doing that, you need to be allocating less capital, less risk in a pure nominal sense, that when things do go wrong and you need to learn, that you don't lose as much. And I think that's part of the point, when you should be dollar cost averaging into risk, or even layering off risk, slicing your profits as things go up as well.
Mm. Just I'm obviously I'm talking to an investment director, and you work for an investment house, so you have an interest in people investing in the market. But I just really wanted to get a sense of how you feel about this idea about contributing to the markets. As markets drop, as I said at the top, it's so difficult to time the bottom, or indeed time the top of any market. How important is it, do you think, over a lifetime, just to keep on doing the same thing over and over again, investing, drip feeding, contributing, adding to your portfolio? Are there any times throughout the life or a cycle of a market where you think, no, hang on a minute, we've got to put the brake on this because it's not going right?
Plenty of times when you may think this strategy is not working, and you revisit it, come up with a new one and start implementing it. Plenty of times. And it really, honestly, that can be during any point of a market cycle, whether you're in the middle of a bull run and you haven't kept up with it, or you're in the middle of a bear run and it's you're finding yourself ahead of that downdraft. So definitely works both ways. But there are no times for me when good habits should be stopped. I, for example, the first day our interns and grads start with us, sit them down, say, right, every day you need to be writing down these key market statistics, 10-year yields, what equity markets done. Get used to them. Get that done every day before you do anything else. And then it gives you a calmness to the start of your day. So you're not immediately sucked into, oh my goodness, the markets were down 15% today. They've started down 10% today. What should I be doing? Okay, let's see where we are. Let's see where those relationships are. Have the relationships broken? Are they still maintained? And that then leads you into immediately thinking about your strategy and how you're applying it to the broader market. And Jeremy, I am very much one who believes talking this stuff through with your clients who are with you with this journey, and actually in a broader market sense, only helps you think through problems, think through what is needed to be changed in terms of your strategy. So all of what you were mentioning there, I think, is important, and you keep doing what works. and try and find the stuff that doesn't and change it.
And of course, one must be mindful of the fact that if you do exit the markets, it costs money. And then it costs money to get back in. And of course, the timing issue is then becoming a really big thing. And of course, that's where people, I think, you have to understand that there are certain costs in exiting positions. Just one final point, if I can, and to some degree, it takes us back to the top as we go into the back end of this year. So just want to get you to quickly reiterate, if I can, about how you think the rest of this year and 2023 will start for us, the investor.
Yeah, of course. So I do think investors need to be wary going into Q4. I think Q4 reporting season for companies is going to be crucial for the setup for 23 and 24, as it often is. But this time in particular, you want to be looking at how well companies have protected their costs. And those industries and those companies that are suffering lower and lower margins, never mind that they may well be reporting good nominal growth, are the ones that you want to be thinking about now, rotating out of into more stable industries with more pricing power. If you can do that now, I think you'll have less pain than you will do otherwise. But I do think the market is going to be reassessing 2023 and 2024 in terms of earnings growth downwards, and that's going to lead to market negative returns into year end. As we get into 2023, we are all going to be talking about how long the Fed will pause at the top of its interest rate cycle. We may even talk about that more than inflation, just for a change. And I think that could lead to some seasonality in January anyway, where you could easily see the equity markets recover a little. But if the market, as it seems to be doing now, continues with the thought that that pause is going to be longer, it may take into Q2, Q3 before we see a recovery in equity markets and risk generally.
Okay, some interesting advice there. Look, Luke, we'll have to leave it there, but thank you so much indeed for joining us and taking time out of your busy day. That's Luke Hickmore, Investment Director at Aberdeen. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.